Hey, quick reminder, today's March 25th, which means a coupon code on Building Your Wealth does expire today. Check it out, a link down below for any of the programs. You get lifetime access to them, and the price does go up over time, so if you want to lock in that price, live streams with me, and lifetime access to that content, check it out, a link down below. You won't regret it. Hey everyone, me Kevin here. Okay, I know feelings might not be great in the market today, and there is a lot of FUD. The indices aren't doing too miserably, down about 0.5%, but there are a whole heck of a lot of stocks, especially in the consumer discretionary and consumer service space, that are getting whacked today. Honest Company down 21%, although that is up from being down almost 30% earlier. But even others like Purple and Affirm down 8.3%, along with Matterport and Etsy down in the 6 to 7% range. Lemonade, Poshmark, Wayfair, Zillow, SoFi, you name it, all of these stocks down over 4 to 5%, or of course more, some of them down 8 or 9%. So what happened? We had good news this morning, and in it was also some bad news, and then there was even more bad news. And so let's break down some of these things. I'm going to start with the good news because, quite frankly, we've had so much FUD in this market, and it's not that it's fake news. It's true. There is fear, uncertainty, and doubt. That it's time for starting with some good news. So let's start with the good news. This morning I talked about how the consumer sentiment survey was going to be coming out. And while the media is picking up on the headline number, which is that consumer sentiment fell a little bit more than expected. The expectation was a read of 59.7. Any number above 50 is optimism. It came in at 59.4, so slight miss there. But the stock market didn't really move on this because this wasn't really bad news. What you did have in it, though, was actually something that surprised me. A sign of good news and light. And again, this is not what a lot of the mainstream media is covering at all. It is consumer inflation expectations 1 year out and then out into the longer term future. These two numbers are critical for what the Federal Reserve looks at for their interest rate hiking path. They're looking at market expectations of inflation, and they could do that with the 5-year break-evens. We talk about this almost every day at this point. And of course, they can look at consumer expectations for inflation. Regarding consumer expectations, we expected that inflation expectations would stay at 5.4% 1 year out and 3% for the longer term, 3, 5, 10 years out. And they stayed. Consumer expectations for inflation, despite the war in Ukraine, did not actually go up. If consumer expectations for inflation go up from, say, 5.4, and consumers start saying, yeah, next year inflation's still going to be 6, 6.5, 7%, and these expectations get anchored into the economy, that is probably your biggest red flag for the Federal Reserve having to rug pull us and force a recession to get rid of inflation. But this is exactly what we've been talking about consistently for the last 2 months. The more the Federal Reserve says inflation expectations are anchored, we do not need to rug pull, the more we want to be exposed to equities under that 50% range on the indices. I don't want to buy them once they've run above that retracement level. Take a look at what's actually happening with QQQ here. It's only down a third right now, so we've got a little bit of a rally coming towards the end of the day. But I want to show you a specific level here, and then we're going to talk about why this is happening. Look at this 50% level here. We got rejected hard here in the pre-market right off of 161.41, which is the 50% retracement on the QQQ. What does that mean? It means that even though the rally has been killing it since about March 14th, the rally has its limits. Now, I drew this right here on my Webull, which this line here is just to depict a potential path that I would maybe expect for the indices. I believe that, I said a few days ago, if we get rejected at 50%, there is a risk that we drop back down to the 23.6 Fibonacci, probably break through that 38.2, and then bounce back up to maybe a new high in sort of a relief rally of this pain afterwards. So this is, I don't think, is just going to be like straight up here. And we're certainly not going to get to this level of all-time new highs again, in my belief, because this would be the area to sell or to hedge your positions up here. Generally hedging over here implies that you really think the market is just going to keep tumbling down. Generally, you want to hedge in this upper third. We're not there yet. So we'll see what happens, but I do think it's going to beget some volatility. Now, we'll see. QQQ's recovering right now into the end of the day. But why are the indices red, and why are some of these other stocks burning so badly today? if consumer expectations for inflation remained anchored. That's a good thing, right? And what's happening with 5-year break-evens? Well, 5-year break-evens for markets, the market's expectation of inflation, those slowly still ticking up a little bit. Still a little bit of a problem, okay? We still got that slow little tick up. But why is some of this happening? Well, it has to do with that dang 10-year treasury and just the treasury sell-off in general. The more treasuries sell off, the more the yields rise. And look at what happened today. It's disgusting. This is happening way faster than I thought it would. Remember how I've said consistently on the channel, I think the 10-year treasury is going back to 3%? We were 1.7 like 2.5 weeks ago. Then we were 2%, 2.1, 2.2, 2.3. Now we're almost at 2.5. This is going to hammer mortgage rates really fast and hard, and it sucks. Mortgage rates are just, they're going up faster than a meme stock right now. And so there is the potential that this is going to depress some consumer spending as well. Now, one of the things that I've said in terms of my portfolio is I want to be more exposed to consumer service style stocks and less to consumer discretionary, especially those with maybe less price power. Now, so far, we have not seen evidence that consumers are not willing to go out there and spend on travel, restaurants, food, Airbnbs, cruises, Disneyland, Universal. If anything, if you look at trends for consumers here, you are seeing moves to the upsides. You're seeing moves to the downside in searches for things like video games, Instagram, TikTok, Facebook, anything that involves staying at home, Wayfair, appliances. But so far, you're still not seeing the consumer actually change their consuming habits, but that could change as those yields continue to spike, starting to put some pressure on individuals' ability to borrow from the lifeblood, so to speak, of their home and use equity from their home to start spending, right? We're going to see less of those cash injections, though a lot of folks are still right now trying to rush to get some refinances in before those rates just ultimately continue to move on up to about 3% for the 10-year treasury, which would push mortgage rates to somewhere around 5 to 5.25%, like we briefly saw in 2018. So this is why I believe you're seeing some negativity in stocks right now, but we've got a big positive set of good news today, so I'm optimistic.